Okay, I think we are live now. Welcome back to our capital raising strategy session. Today we have a special guest, my very good friend, Julie Ann Peterson. Julie is a commercial loan officer with Old Capital. Old Capital is a premier provider of commercial capital solutions and advisory services for commercial real estate investors of multifamily, retail offices, and industrial. Julie Peterson has 30 years of real estate transaction experience. She is just not only sourcing funds, but also consults with our clients to help solve their immediate needs. She works with all types of income producing real estate and all levels of capital stack. Welcome, Julie. And today our topic is impact of lending on a deal. We are excited to have you with us.
Well, thank you so much for inviting me. I am so thankful to be here and see many of you guys are making the circuit. So we know a lot of you, and hopefully out on Facebook world. Also, we know each other. If not, love to make acquaintance with you. So, I'm excited to talk about how the lending will affect the deal. I mean, this is everybody knows about lending, right? That we are your biggest partner. We are taking 75 to 100%. I'm sorry, 75 to 80%. 100% may be, somebody like a hard money lender, but the rates that you get, the terms that you get can significantly impact the deal. Now, you guys are capital raisers. So maybe you think, I don't have to worry about that. But you do need to be considering who the capital source is from the lending side. Do they have a relationship? Does your broker, I'm a broker, does the broker have a very good relationship with the lending source? We've been around for 35 years, Old Capital has. And so you say, so what? We've closed 6,000 loans. That's a lot of loans. And over the 35 years, many of these lenders understand how and what kind of deals that we bring to them. So while you guys are capital raisers, you might not have the relationship with the mortgage broker, but behind the scenes, there's a lot going on. There's the relationship of being able to execute for a mortgage broker to know what is the best fit of the financing for the opportunity is really key. So keeping in mind, you really want to be in the middle of this, understanding what may trigger, whether it's the proceeds coming in lower, the rate coming in higher, and how that will significantly affect you and your investors. Being that we always try to get these loans out there underwritten first before we put out a term sheet, to us, it is really important that our lenders look at the deal, underwrite it, and provide our buyers with the right capital stack and what the terms are. There's a lot of brokers out there that will say, hey, I can get you 80%. So you're going about your business and you're out there as a capital raiser trying to find the other 20%. But what happens when the buyer has bought into this idea that this mortgage broker is saying, I'm at 80%, and Old Capital comes in and says, oh, actually it's 70%. And your acquisition team says, I'm going over here with the 80% guy, they're going to give me more proceeds. And you're getting down to the last 15 days and you're almost ready to close and you're at the half a mile from the end of this race. And that lender comes back and says, oh, by the way, I can't get you the 80%, I'm only at 70. So as a capital raiser, how does that significantly impact the people that have signed up on this deal with you? How much are their shares now diluted? because you need to bring in more capital. That's a problem. So as a mortgage broker, that's how we go about our business. We want to make sure that when you're doing business with Old Capital, that we're giving you the right scoop. And don't be, if you're part of the team and helping make that decision, making sure that you're working with a capital source that's going to be able to deliver. So I think I would like some questions, Vinky. We were talking about how we can, work through today's conversation and how I can be of help to you.
Yeah, and then you said very good thing that the shares get diluted for the LPs, and I wanted to talk about the GPs too, because we have a bunch of aspiring GPs here who are listening to us on the social media or in this meeting as well. So once, let's say we are starting a raise, and if the raise is more than what initially we agreed upon, that dilutes the share for the GPs too, or the co-GPs as well. If you can talk about that a little bit. Because a lot of the times sometimes, when you're new, you do not know, you jump into the deal and you think like, okay, I'm going to raise this much, or I'm going to get this much. And later on, you've been told, oh, we had to raise more. Oops, you're going to get this much. That's a surprise, right?
Yeah. Well, let's face it. When you're under pressure and it's the last minute that you need to capital raise, all you care about is closing this deal because you've made those commitments to your investors. And they are maybe bringing you the money as a 1031, or they're looking for the cost segregation at the end of the year. Everybody has different motivation. So, you just got to kind of understand what your investor is going to find appropriate and want them to stay in the deal. And, is it 33%, 0.33% as opposed to 0.4% now that it's been diluted, and how does that affect them? And if it's a huge investor that has put in a significant amount, what does that mean to him? And then, you have to go back and say, hey, we got the proceeds, and it's a conversation. It's a conversation that may be uncomfortable, maybe a conversation that potentially you lose that investor. So you have to kind of understand what is important to those investors, and be able to communicate effectively how that might that information may be disseminated. Now, from a GP standpoint, we're all excited to be general partners on a deal, and a lot of us work to find the deal, and then we find a sponsor, and that sponsor says, yes, I'm going to help you with this. Your first, second, and third deal as a general partner, you're kind of being thankful for the opportunity to work with these sponsors. And as you grow in your business, that's going to be more and more. You're going to take on more and more of the general partnership. So to think that, okay, from the capital stack, if it got diluted, hey, I think new GPs, we all are grateful that we've got the opportunity, and that I think you keep that in the forefront. As you get down the road in your experience and your tenure, I think that, yeah, that's going to definitely be something that you're going to want to make sure that you're working with the right lender that says, this is where we're going to be. And unless something significantly changes, this is where we're going to be. And those significant changes are the seller takes their foot off the gas. And, the seller is as excited to get out as you are excited to get in. And we will see that these sellers want to forget about what's going on here, and they feel bothered by, oh, you're asking all of these questions, because they're on to the next deal. And in that, we see some of the sometimes the economic vacancies deteriorate, and that does impact the deal. So that's outside of what the lender can do. Based on that snapshot, I can tell you, okay, I'm going to give you 70% based on the information I have today.
So what is the best way to structure a deal in your perspective, being a lender? Because, as a borrower, I might want it to get, more loan or more debt so that I can leverage, I can have better returns. So where do we meet kind of in the middle? What is the best structure will look like?
Well, I would tell you this, in an environment where we're at right now, low leverage is where you want to be. And I think that if you are looking at what's up ahead, the winds that are up ahead coming, we are seeing an increase in interest rates. We're seeing inflationary conditions. How's that going to affect the rent growth that we are experiencing currently? It's not going to continue. We're going to see it for another year, 2 years. But some of these business plans that are in place right now, they're highly leveraged. And if something happens, we're going to see that these business plans are not going to be able to be executed. And therefore, in 3 years, I think you're going to see some opportunities to be able to take over those assets that are half done. Okay, we have a shortage on appliances. We've got a shortage on people that want to work. We have a shortage on simply getting product over here from overseas. Many of these, a lot of people use foreign products. And so I'm seeing even currently property managers that are not able to keep their staff. And so they're not keeping their staff. That's delaying the CapEx. That's delaying the returns. That's delaying the business plan. Okay. So making sure that you have the capital in place that it can take some of this downturn is highly suggested, right? I mean, you just don't want to be up into the 75 and 80% and not be able to pivot. And I think what you're going to see more and more is that the leverage is going to start to deteriorate. We've already seen that on agency. Agency right now is 45, 50 to 60% LTV. Before we were at 75, 80. Well, the pricing on the assets right now is so high. We just aren't, the properties are not performing to get to the sale prices. So therefore, that's why we see 80% of the business right now being done in bridge. And the agencies recognize that, and they're not going to be participating. But on bridge, as we see this, becoming more and more difficult to get coverage on your debt yields, we're not seeing that to stabilization. We're not able to see debt yields at 7.5. Then they're going to start to pull back, and we are seeing that. So I think that, I'm not sure what the question was, but these are the vehicles that we're seeing right now, and some of what the deterioration on proceeds are. But I would definitely be looking at lower leverage.
So, but if it's lower leverage, so the overall profit is going to be lower too, then, right?
That's right. And your returns are not going to be up into the 8 and 10 cash on cash. They're going to be in the 5, 6, maybe 7. But keep in mind, that's a heck of a lot better than what you're going to get in your savings account. And you're going to get the tax benefit as well.
Yeah. So what are the measures that we can take to just mitigate some of these pitfalls or some of the issues that we're seeing in today's market?
Well, I think instead of doing just a small rehab, if you can look at doing a heavier value add where you're looking to really change your tenant base, if there's other assets that are doing this currently, taking a look at that. There's a guy in Phoenix that is buying a C and bringing it up to A. Those are significant renovation plans, but it works, and they're making tons of money. So if you can find an asset that is primed for a heavy renovation budget, and it supports, maybe there's an A product or a high B down the street, and you've got an asset that's a B, is in a B area, that if we could get it to an A minus and at lower rents than the A product that's brand new, I think it's a compelling story. But keep in mind, we have to have the capital to support that. We have to have, in case the lender doesn't like to bring in all of the capital stack, that you have the capital to be able to raise that to close. Or perhaps you raise that outside of the initial, I'm only going to bring in, we're going to do all 100 units, but maybe we're only bringing in 50, and the capital stack, or rather the CapEx budget, is only 50% to the lender, and you raise outside the rest of the 50, just in case. Because what happens if you pivot and it doesn't work? You can actually, sell that, whether you at 3 years, you could, look at it and say, you know what, I think it's time to get out. We haven't done 100, we've done 50, but we've renovated, we've raised the rents, we've lowered the expenses. It is a compelling story.
So you're saying our business plan has to be solid, and the lender has to buy the business plan that we put together. They have to believe in our business plan that it's going to work. And
Absolutely.
accordingly, they are deciding on the debt, right? That's what you're saying, like
Absolutely.
what percentage they want it to come in. So can you share some tips with us, since you're a lender, that what could make our business plan stand out and it resonates more with the lender?
Well, I would tell you the biggest thing is rent comps. That is a significant impact on making these decisions. So your rent comp, that you can make sure that your business plan says, hey, I know that ABC, DEF, and GHI apartments are this vintage. They're a little bit higher vintage. They're smaller units. They have the same amenities, and quality of the renovation is the same that we're doing, but I've got larger units, and I'm going to come in, let's say $200 above where I am today, but I'm going to be 100 below where they are. It's really making sure that this business plan is in place already, and you're just somewhat mocking it. You don't want to be the best on the street, that's for sure. You want to be a little bit below what else is going on. Okay, so your business plan, your renovation budget, your CapEx budget, making sure that that is in line, that you're not spending only $3,000 a door. A lot of these bridge lenders want to see $5,000 a door. What was $5,000 a door pre-COVID is not the same $5,000 of what it is today. A lot of what was $5,000 back then is now $8,000 to $10,000. So making sure that whatever renovation budget you have it can be substantiated, okay, in that business plan.
Let me interrupt you for a second. When you say pre-COVID 5,000, now it's maybe 8,000, 10,000. So what I'm thinking is, so maybe there is some kind of set criteria that you guys look into. Okay, this is going to cost this much, this is going to cost this much, because from a borrower's perspective or from the asset manager perspective, I might think I can fit this thing in this much budget, but your budget might be different than ours. So wanting to understand that what kind of guidelines you have, or what tools do you use to calculate all that?
Yeah, so in terms of the cost associated with each of these, what is a $5,000 a door renovation? It's paint, some fixtures, it might be the counters, right? And in different areas, it costs different, right? It's going to be more expensive on the West Coast and on the East Coast than it would be in, Omaha, Nebraska. So I don't think you would say there are guidelines, but there are compelling what do we really think that on a small kitchen, is it really 5,000, or is it more like, well, if it's a normal size, there are no real guidelines from a lending standpoint. But if you can explain it to us, we're gonna come on board. Now, when it comes to taxes, there's no real conversation there. When it comes to insurance, there are some guidelines. We know depending on the certain area, what we've seen, and that changes, that fluctuates. We're getting hit down in Baton Rouge, where all of the Gulf states are getting hit right now. What we saw 60 days ago on quotes is not what we're seeing today. And unfortunately, that's unfair. Hey, wait, you quoted me this, and now we're here. And your whole business plan is based on what we saw 60 days ago. So some of that is, there are changes that are going on in different markets. What happened last year in Houston and a lot of Texas, where there was freezing rain, and that is starting to hit now. That's impacting insurance rates. So, those things, we have a guideline, but things change. So, in terms of your R&M, there are different guidelines from market to market. There are different guidelines for your payroll. Is your payroll included in the management fees, or is it separate? Depending on the size of the deal. If it's below 100, you're probably not going to have a payroll, but your R&M is going to be higher because you're going to have to schedule out somebody who's a contractor. That's going to cost more than having somebody that is on staff. So those guidelines are they're fluid, and really what we're looking for is you guys to present it to us, what you believe to be true. When we look at bridge loans, we're looking out into the future. So if you think that it's going to cost you $200 in advertising a month, and we think it's only going to be 50 to 75, then we have a conversation and we say, hey, this is our plan. And we go, okay, we can wrap our hands around that. On the expense side, a lot of times it will be determined by what the appraiser sees. Okay. And we can adjust those and have conversations and kind of figure out where the plan is. But they're not necessarily all hard and fast rules.
Yeah, thanks for sharing that there's no hard and fast rules. So everything is pretty much negotiable. And as long as you understand your business plan completely and how you present it, that's very important too, because the other person has to see your vision and align with it to get you to the finish line. And then you have done wonders, Julie, especially in the last year. So remind us how many millions dollar worth of deals that you completed this year or last year?
$1.2 billion is what Old Capital closed last year. And I would tell you a significant amount. A significant amount in Q4 was done just in that one quarter. To the point of almost the same as the total done in 2019. It's crazy how much business was closed for everyone in Q4 of last year.
Wow.
Yeah.
Wow.
Now,
That's
some
awesome.
of that is, because people were buying and selling. It was just everybody was trying to close before the end of the year. People were trying to place capital because of the bonus depreciation, this being the last year at 100%. So there was a significant impact. There was a lot of people concerned about the market from the stock market, and so we saw some of that also impacting the amount of deals that were getting done. I think that the stock market, there's some uncertainty as well. So that picked up. And also we saw people coming over from retail, from office. That was also impacting the numbers in multifamily.
Yeah. And then with this interest rate going up and then the inflation on the rise. So what is gonna look like the future? Can you give us some
Well,
insight into the future?
my what do you call it? My crystal ball,
Crystal
it's
ball.
broken. Okay. I went to Walmart, they're all out. So I might want to go to like Brookstone where maybe there's a higher quality, but I would tell you that there are many, many, many people that are bullish on multifamily over the next 2 years. So I think that there's enough evidence that says we're going to continue to see rents go up. We're seeing population growth. There's not enough deals that are coming online that when I say coming online, that's new builds. It's going to take people 2 years to get them up. So the absorption rate is significant in a lot of these areas. So we need to get more and more. And that's going to take, like I say, a couple of years. With the inflation, I think that there's a lot of now with the Russia deal, I think that has been a concern. People are running around scared. For me, I say stay the course. Be on the lookout for opportunities whereby, these people have taken bridge out. You could have done nothing on some of these deals over the last 2 years and you made a ton of money. I don't necessarily think it's going to be to that extent, but I think it's going to be pretty magical if we keep going. Hopefully this Russia thing and stock market isn't going to cause much of a problem. Let's say that.
So do you think that with all this rise in interest rates as well as in inflation, at some point it's going to affect our demand and supply, and which might lead to recession as well, right? A lot of people are thinking about that as well.
Yeah, well, we see the inverted curve that we've seen over and over and over historically. When it goes down, right? And we see that in single family. And we're seeing in the inverted curve. So how long is that do we have? I think we're probably 2 years away from that. To what extent will we be impacted? I don't know.
Mm-hmm.
Hard to say. I'd hate to put my stamp on, yeah, this is what's going to happen. I don't think I don't have enough knowledge yet to say that.
Yeah, hard to predict, right? So many viewpoints out there and everybody's thinking from their perspective.
Yeah.
Thank you so much for sharing that. And I'm going to ask all of our friends on the social media who are listening to us, please chime in. If you have any questions, put it in the comment box for us. Facebook, YouTube, LinkedIn. I do see a lot of people watching us. And also, hi, Julie saying hi. And also, I wanted to ask my friends and my colleagues in this GOB session on Zoom, if you have any questions, please take yourself off mute and ask now. This is your time. Julie's here.
I would want to also point out that as a capital raiser, many times you get into being in the capital stack as the capital raiser. I would encourage you to be thinking about partnering with 2 or 3 groups, getting a solid relationship so that you can be a faucet for them. When they have a deal, they call you. When the other person is, doesn't need you, you've got a place to go. So you have a real fluid delivery of capital for your clients. And you do that 2 or 3 times for a group. Now they are thinking, hey, you are part of my team. And by the way, I want to incorporate you into this, and I want you to be part of the general partnership in signing on the loan. Okay. A lot of capital raisers, there's my dog. Let him out. Can you keep talking amongst yourselves? I'll be right back. Sorry.
Yeah, sure. Yeah, I think she raised a good point when you pick couple sponsors and work with them back and forth. So that way, you're always raising, you're kind of in the capital raise mode. You're not taking yourself off of that mode or taking a little bit break, and that might put you behind. And trust me, if you're not raising all the time is going to come when you're going to be chasing capital. So I like that idea, Julie. So carry on, please.
Yeah, I would tell you that what you want, when we talk about experience as a general partner, we're asking for you're responsible for the paying that loan as a general partner. When people say, oh, I'm a co-GP, well, from a lending standpoint, they're going to open up their computer and they're going to go, Angel Williams, has she signed on the loan? Yes, she has. If they say, Steve Biggs, not Steve Biggs, but Steve Biggs, they don't see Steve Biggs's number come up on their computer because he hasn't signed on any loans. So my point is, get in with a group that you can, get so close that now you are part of the team and you're signing on these loans. That's going to be your growth and how you're going to build your team with these other groups. Some of us, that's just not, we have to wait for deals because maybe this is your strategy is you're going to only be capital raising. Yes, you know how to underwrite. Yes, you know how to do asset management, but your real skill set is as a capital raiser. So there is a tremendous value of your job and what you do. And you need to be on a team that values that and says, you are my partner and I want you on signing on these loans. It's super important. And that should be what you're striving for. That's why I say, work with 2 or 3 groups. Remember, you always have to do a job when you're capital raising. So why not be part of the general partnership, signing on the loan and getting credit with the lenders?
That's true. Build up your resume. That's the best way to do it. I agree on that. So let me remind everybody once again, if you have any questions, this is your time now. Take yourself off mute. And if you're on the social media listening to us, please put your comments or your questions in the comment section. So I do see a couple comments. I think there is one from Shelby G. Davis. He says, renovation costs are outrageous. The second comment is always include contingency for inflation, especially now. That's a good one.
I'm sorry, I didn't understand. Was it a question or that was a comment?
He just commented. He says always include contingency for inflation.
Contingency, correct. Yeah. You really want to make sure that I can go down to 50 or 60% of my vacancy, occupancy, right? So that I'm still getting capital to pay your interest only loan. Just make sure you're very clear, especially you're clear and your property manager is clear, because your property manager most likely did not sign on the loan. So you got to make sure that they understand what your threshold is. Otherwise, you're going to be responsible for a default. Jim.
Julie.
You went a long time without talking.
Well, you girls were just giving so much great information. I didn't want to interrupt. But I wanted to ask about the O Capital Speaker Series. And is there anything from that meeting last week that is pertinent to today's call in relationship to inflation rates and how the capital markets are responding to everything?
Jim, I didn't go to the meeting and I didn't get a follow-up to that speaker series. So I got locked out because of the weather. And we only had, I think, 50 people show up out of like 300. So it was unfortunate. Angel, did you go? No, to the speaker series.
I was at BC.
Oh, she was at BC. So, we had
I drove. I didn't have airplane issues.
Okay, there you go.
I completely forgot about all the grounded planes and everything last week because of weather. But you had mentioned about the rates starting to rise. And I know that over the last 5 years, there's been several instances where they've tried to raise the rates
Mhm.
and maybe even got a quarter point in or half a point in and then had to retract.
Yeah.
Over the last 45 days, what have you seen and how does it relate to that?
Yeah. So over the last 45 days, even less than that, last 30 days, we have seen an increase almost, if not at 100 points. So that's 1 point. 100 basis points is 1 point. So we've seen a rise in that. However, we did just see a decrease on the 10-year treasury, and we're seeing that in single family. The rates were in the high fours, they're coming down. So these guys don't necessarily go hand in hand. They're closely, but they watch each other. I think the speculation says that we're going to get up, it's going to go down a little bit. It is going to be a little bit of a slow rise and fall, but over that period of time, over the next 2 years, I think you're going to see at least one and maybe a little bit more on the interest rates.
And we have seen over the last 2 years, the private equity and bridge lenders really step in and support the market. And Fannie and Freddie, it seems as if their appetite has been very much to sit on the sidelines. Are we forecasting any change in that, or do we think next year will continue to be a big presence for bridge loans and CMBS?
I think there's still going to be a strong push on the bridge just because you can roll in that rehab. I think agency is still getting done. A lot of people actually are starting to go away or pivoting, if you will, away from these bridge loans because the costs associated with these bridge loans, guys, is extremely expensive. So you've got the rate cap that is based on the bond market. So if stocks go down, bonds go up. So, 3 years ago, the bond market was down because the stock market was up. So this is where agency worked. As the stocks have been coming down, the bridge loans have been an amazing option. But the rate caps that we put on these deals, again, they're based on the bond market. And as we're seeing the shift, these rate caps can be, $75,000 to $250,000. Okay, that rate cap, you buy it, it is usually 1, 2, or 3 years. As you get out in 3 years, you're speculating. We can speculate 1 year. We'll do a little bit better at 1 than we do at 2, but when we get out to 3, we're not really good. So you're going to pay a lot of money. So here's how that gets affected. You pay the rate cap for, let's say, 2 years. You need to be in this for a 3rd year. And what happens? You bought that rate cap for 100,000. If the bonds are up and you need it for 1 year, it could be you're paying another 100,000 for 1 year where you paid the same for 2 years. So we just don't know. So when you get there, how do you underwrite that? You don't know how to underwrite it. So some people say, I want to sleep tonight. I want to sleep for the next 3 years, and I want to pay 250,000 for this 3-year rate cap. I mean, it just depends on your level of experience and your strategy and how adverse you are to stress and loss, right? Is really what it comes down to. So if you are in a low leverage deal, you've got capital on an interest only note, that might not be such of a problem as it would be if you're at 75 to 80% leverage, and now you have to go out and you might not be at the end of your business plan, and now you got to go buy another rate cap. It's significant. It can impact you significantly. Okay. Again, people are thinking these fees, one in, one out, rate cap, application fee, 50 to 75,000. That's a lot of money. And you're getting, let's say 4%. Well, you can walk down to the bank. We can help you with this. You can get a 4.25, a little bit more expensive. It's a 5-year loan and interest only for 1 year. And maybe you could go with low leverage on that deal at 60%. And you've got 1 year interest only. You might, if with that low leverage, you might be able to do all 3 years of interest only. You could do basically have your business plan completed and you don't have the rate cap, you don't have the application fee, you don't have the in and out fees. So don't be necessarily stuck on a bridge loan that has all of these fees. Maybe it's best to look at paying a little bit more when you don't have those. You can maybe go with a fixed rate bridge. Maybe it's a little bit more. Maybe it's 5.75, 6%. You have to figure out what lever you can pull that makes sense. Maybe it's the bank. Remember, bank loans are recourse, and recourse hits your balance sheet. That means if you want to go out and buy a house or a car or put your kids through college, they're going to look at how much debt you have on your own balance sheet. Not a lot of syndicators want to get involved with that, but we are seeing a shift in that because a lot of people who are getting into these loans, they do have good experience. They know how to run their business. So for them, that business plan can get executed with the lower rate, or rather the lower fees coming out of a bank. And we can certainly help you understand what that looks like. That answer your question, Jim?
Yeah, absolutely. I also wanted to ask a little more about the difference between bridge and agency debt. If you could expand a little about how that might affect your business plan and why so many people are choosing bridge over the last year. You had mentioned it briefly that one is looks backwards and the other looks forward.
Correct. So let's just talk about agency. So agency is a government-backed securities, right? These are the government is watching it. They own it. What they want to do is give long-term debt, 5, 7, 10, even 12-year loans. We're going to give you a little bit of interest only. You know, on a 5-year, you might get 1 year, 7, you'll get 2, if the numbers make sense. 3 years for a 10-year, and maybe even 4 to 5 on a 12-year, interest only. That's not the same as a bridge loan that is interest only for the term, 3 to 5 years. Okay, so agency has requirements. You have to have a 90% occupied for 90 days. Okay, that's okay. I will find an asset that fits that. We also need net worth greater than the loan amount. So when you're putting these groups together, these buying groups, your partnerships, your team, you want to find people, you want to find the smallest group as possible. So you're looking for partners that have the highest net worth that will be able to sign on the loans. Okay, they may not have experience, but maybe you have someone else who can check that box. So 90% occupied, you got net worth greater than the loan amount. The next one is liquidity. I need 10% liquidity. It's 10% of the loan amount in cash after close. So let's break this down. $10 million deal. Theoretically, we get you 75% of the loan amount in proceeds. So that's $7.5 million. 10% of that is $750,000. So I need $750,000 sitting on the sidelines from your group. Okay, so maybe you don't have it, but that high net worth individual has the capital, and you want to find people. Capital is king, right? It's like crack. You just want to place it wherever you can as quick as possible. So a lot of people don't have liquidity. You got to find that person. That's a very valuable position, to find that person that you can have that liquidity. Okay. Everybody wants to deploy their capital, but many of these limited partners or general partners, they know that that is a big value to a lot of these apartment transactions. The last piece is experience. And when you're new, you need somebody on your team that has experience. Typically, as an agency, we want to see 2 years of experience with 3 to 5 transactions. Now, we were in a situation where the person who was bringing the general partnership only had 22 months, only 2 months short. And what did Freddie say? I can't do that. Seriously, you're not going to do this? No. We're going to close this in 60 days. Can we get, because that's going to be 24 months. No, unfortunately, we can't. It's the time that you sign the application. You have to have 24 months. So they look at this very, very strictly, okay? So 2 years of experience with 3 to 5 transactions. Now, I've got a bunch of single families. Well, if you got 50 single families and they're, in an area and you've owned them for 5 years and you're going after a 50 unit building, I think that's a compelling conversation. If you're a limited partner, hey, I got experience. No, unfortunately not. We are not going to call that experience. Okay, so you got to find these partners that have this experience. It's critical to getting these across the finish line. Okay, so that's agency. On these loans today, you've got a debt service coverage of 1.25. A lot of these deals cannot get the coverage. And what does that mean? That means the amount of income that comes in, and after all your expenses are paid, you have to have a coverage of 1.25. 1 to 1 would be you have as much money coming in as how much you pay your mortgage. That means you have 0 left. The banks are saying, no, I need to have a little bit of leeway. I'm asking you to cover it 1 plus a quarter. Okay, so you have to have leftover. In these smaller markets, we're seeing 1.3, we're seeing 1.4, and in some cases, 1.5. So while everyone is trying to get in an MSA and it's very, very challenging, they're going outside. Okay, that's great because there's opportunities. But what you have to know is that not all lenders want to go out into BF Egypt. Okay, they're going to say, okay, we'll do it, but we're going to charge you. We're going to probably not give you as many proceeds. We're going to have a higher debt service coverage ratio. And we're going to pull back. It's not going to be 70. We may be at 60. So those are things that you have to consider when you're going out of the major metros. Okay, that's agency. When we go over to bridge, oh, by the way, in agency, typically we're not rolling in the rehab. Again, right now we're seeing sets like 50. I've seen 45% coverage, leverage, 45% to 60%. There are deals. I just closed one at 75%. Hey, there's still agency deals getting done. They're hard to find, but they are getting done. And each of the agencies, your Fannie and Freddie, they have $140 billion to place, and they're placing it, right? So there are deals getting done.
So Julie, we've just had an hour packed of great information. If anyone wanted to reach out and learn more about you or more about Old Capital, how would they do that?
Well, I'm on all of the social media. So LinkedIn, Julie Ann Peterson, LinkedIn, Facebook, Instagram. You could find me on Zoom at 8. Zoom at 8 every Tuesday night. You got to come. It is networking and we learn. I set this up 3 years ago. We've closed 10 deals. We're getting ready for our 11th. And this is where you find your partners. Okay, so look on Facebook, put in the search Zoom at 8 p.m. Eastern, EST, and that's where you can find me. All my contact information is on all of those social media sites. I'm happy to jump on a 15-minute introductory call to kind of figure out how I can help you.
Thank you, Julie. I think this was a really, really insightful session. But before we go, I wanted to quickly share a disclaimer that I forgot to do that. This session was totally educational. By no means we are trying to sell anything or wanting to share some information that is not applicable to you. So please, if you have any further questions, reach out to your CPAs, your attorneys, or Miss Julie as well. Thanks
Thank you.
again, Julie. I really appreciate you coming, and especially on a short notice, and giving this, insightful ideas and tips so we can work our, debt and do more deals.
Thank you.
really
I appreciate it.
Thank you so much.
Thank you,
Yeah.
guys.
Thanks.
Thank you.
If anybody has any questions, please chime in. I have a hard stop at noon in 2 minutes. Jim, you were going to say something?
No, I was just saying thank you very much for everyone online and in person attending. And thank Julie again very much. And remind anyone that might be listening, if you'd like to learn more about the GOB Network, we're a nonprofit educational platform. And Julie is also a member and helps us with a lot of the loans that members are trying to get done, and provides just a ton of educational content and help. So just go to the gobnetwork.com to find out more.
Perfect.
Thanks, everyone. See you next time on next channel. Peace.
Thank
Have a
you.
good one. Bye.
Bye.
Bye-bye.
I have a quick question. Is this the link that we use every week from now on?
Yes.
Yes.
Okay.
Yeah. And I changed it. I deleted all the links on the Slack channel that weren't this one.
Okay.
So that
I
people
couldn't
would-
find them anywhere anyway. And then when I texted Binky, she's like, "Oh, it's okay." I'm like, no. I mean, I can't get in. Like, I literally can't get in. It wasn't that I can't attend. It was that I can't get in.
I
Sorry
did
about
have,
that. Misunderstood.
No,
Yeah.
I wasn't very clear.
Yeah.